right, it's come that time where we're going to do a little preview of the FOMC meeting that we're going to have a little later on this afternoon. And for that, we're going to have event trader Gavin McGuire and chart trader Brett Manning joining me to discuss what we might see and how we might want to look at it and trade it. So, gentlemen, thank you for joining me today. This is one of the bigger events that we've had for the Fed in quite some time. I mean, they are all important. However, this one has the makings of something pretty big, wouldn't you say, Brett?
Yeah, I would say so. This is somewhat of a defining point, and there's a lot of things we're going to talk about that have to do with more than what we typically end up talking about with the Fed lately, given what's going on in the repo market. But we'll get into that a little bit more.
All right, before we get too far away and into a very deep discussion, why don't we talk about what we are expecting for a base case scenario? I'm going to hand the mic over to Gavin for this one because I do want to highlight that he did just post a Fed preview. So if you'd like to follow along, just type in EVENT. You'll have to scroll down just a little bit on the in-play page, but you'll be able to find it. So if you get lost, that's a good reference point for you. And he does lay out a base case scenario. So Gavin, why don't you break that down for us, and we'll just work our way off that.
Yeah, I think generally what the market's looking at for the base case is a 25 basis point cut to the Fed. And Brett, feel free to jump in if you agree or disagree with anything here. Economic language to remain pretty much the same. Last one was economic activity has been rising at a moderate rate. I think that the data that we've seen over the last 6 weeks continues that story. July 31 is, of course, when the Fed last met. Wouldn't expect to see some softer language around business inventory. Obviously FedEx last night and AT&T at a conference too had pretty cautious commentary around business spend. So I think that they kind of use that as the basis for why they cut 25 basis points here. I would expect to see this more than likely in the Q&A, but as Brett just mentioned, that repo action really provides another layer of intrigue to this afternoon's announcement. They didn't address the repo market per se in their July 31 comment, but they did have in it, the committee will conclude the reduction of its aggregate security holdings in the system's open market account in August, 2 months earlier than previously indicated. And that certainly played into some of the repo action that we've seen, just a drying up in liquidity. So I don't know if they'll address this in their in the statement, but I definitely expect to see a separate press release with regards to this from Powell and company, and for Powell to be asked this regularly in the conference call. So curious to see kind of how that plays out, but my assumption is that we could likely see the Fed go back into QE, but it being couched a little different than in pure easing, but rather a structural change. And the same could be said about its IOER rate, which is basically the rate that it charges banks for keeping money on their balance sheet. So they're two items that I think are expected to be addressed in this meeting. And then the dot plots, I think the general case is for them to be not as dovish as some would expect in terms of looking at 3 or 4 rate cuts going into 2020. So I don't think that they're going to hit those levels. And then the GDP and inflation expectations, I wouldn't expect them to change too much from the June projections that we saw. And I'll post the June projections here in a little bit. And I believe in talking with Craig that we'll also be getting a first glance at those 2022 outlooks too. So not sure what quite to expect there, but I don't think people are overly concerned. The Fed hasn't really proven itself to be very proficient at forward outlooks in terms of their projections, so I think people will take that with a grain of salt. It'll be interesting to look at, but won't really weigh too much on trading activity. And then I guess one of the big outliers is around inflation and how they will address that, because inflation has been a little bit hotter than it had previously been. And the one comment that I'll be curious to see if inflation stays in is the one from July 31, in which they stated, in light of the implications of global developments for the economic outlook, as well as muted inflation muted inflation pressures, the committee decided to lower the target range for the federal funds rate to 2.25%. I'll be curious to see if they leave that inflation in there, but that'll be one of the things that I'll be watching for. So I think that's pretty much the base case, Brett. I don't know if you've got any, if you take any umbrage with any of those statements.
No, not really. I mean, I think that we have solidified a 25 basis point cut as as what we're looking at here. Yeah, I mean, I think that the language is probably just about as you laid it out. I think that what we're seeing, I think it's important to almost kind of start this conversation with attempting to get a big picture understanding of what was happening in the repo market, why we've started to see this extra stress, and what it implies is wrong, and what the Fed would probably be motivated to do. So my understanding at this point is you're at this big kind of historic moment in terms of we've gone more than a half decade with a certain amount of Fed participation in financing the issuance of debt, because the Fed has been the biggest buyer of treasuries for a lot of that time. And foreign buyers like China have been absorbing a lot of that responsibility as well. So at this point, we're seeing all of that responsibility go back to where it used to be, which is on the big banks. The big banks are once again, by far and away, taking a lot of the issuance when the Treasury comes out and puts another 80 billion out to finance the deficit, or 100 billion or whatever, as we go through and try to finance what are record deficits at this point. So we're issuing a record amount of debt, and we have less foreign buying and we have less Fed buying. And so it's basically falling all on the big banks, right? And the big banks have a certain amount in excess reserves. They've been using that to purchase bonds. And so they've been skirting it really close to the minimum levels in just straight cash that they're really supposed to have. And at this point, we came into this week with things really kind of cutting close, because the banks keep excess reserves so they can provide enough liquidity themselves to settle large transactions, particularly in the overnight market. Big money flowing from big different account holders, leaves one place, settles in another place, and there's a little bit of a lag, and there's money that kind of seals up the gaps on both sides and allows all the rest of the fractional reserve system to kind of keep greased up and moving. So they have excess reserves that do that, but they've gotten down to pretty much the minimum levels that they could ever have to keep the banking system working, because they've been buying so much of Treasury issuance. So at this point, the stress has fallen more and more on the repo market, which is sort of this overflow point for when those excess reserves are tapped out and they need to finance more transactions. They go to the repo market. And over the last month or two, it's been getting tighter and tighter, and there's been more and more weight put on the repo market to fill in the gaps. And when we came into this week, we had sort of two things that kind of function like the straw that broke the camel's back. One, taxes were due for quarterly corporate payments to the IRS. And two, we had settlement from a $78 billion bond auction, both hitting on the same day.
And so only $24 billion in redemptions too, so it's the spread there that's key, right, Brett?
Sure, yeah. So, but the demand, the money coming out of banks and going, in this case, to the IRS and the Treasury, hundreds of billions of dollars, all on the same night, when you were already at a point where they were left with basically the minimum scraping by amount of cash in excess reserves, and already stressing out the repo market, which provides that extra buffer. So they were really relying on something that should have been more, a just-in-case situation, and it became kind of matter-of-fact part of the course of business, and then you got one particular combination of events that pushed it sort of over the line. Now, it's unlikely that kind of moment's going to happen again. It's sort of a low probability risk, but it's necessary, because if it does happen again, it does impact the real economy, because it affects things like short-term commercial paper markets, and you've got big utility companies, you've got big food producers, you've got really important people for keeping life going in the country that finance constantly hundreds of billions of dollars.
GE being a key player in there too.
GE being a key player. There's a massive demand for commercial paper just to keep the basic wheels greased, and you really need this market functioning properly so that money doesn't get too expensive. So, I mean, the Fed's going to need to have a solution, And it's either they're not going to get foreigners to start buying more bonds, and they're not going to get the deficit to go down and the Treasury to need to issue less debt. So either they need banks to have more money, or they need the Fed to be buying more bonds. One of the two.
Right, which suggests that QE restarting, because we're certainly not going to get any regulation changes on what banks need to hold on their sheets to get them moving soon.
Yeah, exactly. I mean, you're going to need to have some solution, and it suggests that the Fed is either going to have to beef up bank reserves, or it's going to have to start taking on government bonds on its balance sheet. It's one of those two things, because it's not going to be lower issuance of debt, and it's not going to be China buying more bonds again. So I think we can expect something, because they're not going to want, even if it's a low probability risk, they're not going to want that risk to sit there and have people start to act according to the possibility that it could happen, right? Because even if it's a low probability risk, it still changes behavior if people understand that it's a risk that things could tighten up and their commercial paper rates double overnight. So you just can't have that. So they're going to need to solve this, and my guess would be a targeted program that is a transition. It's not really a change in monetary policy. It's accommodating a transition, and this is probably, you could look at this as one of the big points of just, okay, we went through this process of QE for years and years and years. We built up this huge Fed balance sheet. And now we've done quantitative tightening, and we've reduced it back down. We've gotten to the lowest level that they thought they could be at, given all of these dynamics. And at a time when, there's so much debt being issued by the U.S. government, that's higher than one would think it would need to be, but that's where it is. This is obviously where it is. We're seeing right now that they got down to as low as they could get. And part of making that transition, we've never really made that transition before. Part of making that transition is hiccups like this. And so they're just basically going to patch the hiccup. And like I said, it's going to be either that they're going to start buying some government bonds, so sort of like the QE light idea that Jeff Gundlach was talking about, or they're going to find some other way to beef up the reserves that are at banks.
Brett, is this also maybe is another way to look at this? Is it a convenient way for the Fed to be able to keep QE rolling so that you kind of have it underlying. It's underlying so that it can keep things kind of moving, but it's a nice, I know it's not necessarily an excuse, but for lack of a better term, an easy way to keep QE implemented into the system.
I mean, it's an excuse, I guess, but it's going to be used for this purpose. So I don't think that this is going to be viewed as an economic stimulus.
But not at all. So the headline won't read for the algos that kick in. It won't be one of those triggered type bids that just kick into the market that can be faded. That's basically what I'm looking for. I'm looking for some type of overreaction to QE that could potentially lead to a fade, and if that is possible.
I think that it's possible. I mean, I think that there's very few people who probably understand this situation well enough to see that that wouldn't be economic stimulus, and that there would be an initial use of a keyword that people would recognize, and then over the course of the next couple of days there would be analysis published that would suggest that it doesn't mean the same thing in this case. I don't know that if it would be something to fade 10 minutes later, and I don't know what else it will be accommodated by. If there is additionally a statement about increased risks in the system and increased downside risk to the cycle, and there's also a rate cut, it may be tough to disentangle.
Real quick, just on this topic, there's some Jamie Dimon headlines crossing. Just noting that the Fed did the right thing on money markets, and dislocations still being studied for what it's worth. Also, both a Merrill headline crossing about the Fed needing to do about $150 billion a year in purchases to maintain the reserve levels where they're currently at right now. So just throwing that out there.
Yeah, and that would be the patch. That would be
exactly
the overflow to allow a situation where we can keep the same. Again, it goes back to the amount of debt that we're issuing. The bonds take up space on a balance sheet, and somebody's got to buy them, and it falls to the primary dealers when it's not going to be all foreign buyers or the Fed. So you're pushing that into a place that wants to be filled with money. And that money finances big transactions through the banking system, and you push a bunch of debt in place of that money, and you crowd out the money, and you get a bunch of increased chances of default on overnight transactions in banks, which have to be patched up by the repo market, which drives rates on repo money up. So they have to beef up the money, so they're going to expand the size of that space that the bonds have crowded into to make room for more money. I don't know if that makes sense, but some form of that will happen today.
Yeah. And the longer it persists, the bigger concern it's going to be for the markets, because then like Brett was saying, once you start getting into some credit issues and defaults, that's when things could really turn south. I mean, that's basically how the 2007 financial crisis started. Now, granted, it wasn't as much of a structural issue as it is currently right now, but still, it raises concerns with counterparty risk when you start seeing big spikes like this. And that's what it really hurts, when people start holding back money in this market because they don't know who could repay them and who can't. And that's when the snowball starts. Yeah,
well, and I would highlight that the difference between then and now is the difference between insolvency and illiquidity. And that's an enormous difference, but people could make that error on a moment-to-moment basis.
Yeah.
All right. So any of these announcements, will this be the initial thing that we get from the Fed, and then we'll have more follow-up due after the Q&A?
I would think so.
Yeah, I mean, for me, I don't think anything in the Fed announcement should really move anything too much. I think the whole key for me, and I don't know about you, Brett, is that Powell can't go stumbling and stuttering through his press conference. He's got to show that he's in firm control and ease the market fears, because I think that's the greatest fear in the market. If he comes out like he did on July 31 or back in December 18, and he's kind of stumbling around on things, and people are like, these guys don't know what they're doing, then that would definitely be a big crash, because that's probably the biggest problem with this repo market. While it's a structural issue, there's already the idea in the markets that the Fed doesn't really know what it's doing. And when you start seeing these repo rate and overnight rates spiking, that kind of lends a little bit further credence that the Fed's in above, a little bit above its head. And I think that that's really the entire key for this afternoon.
Yeah, and I would say it's interesting that this is the first time in I don't know how long that we've had a chair of the Fed who's not a banker, right?
Right.
So he's
a finance guy, though, right? So
he's a finance guy, but he's probably not a repo market guy, and he's probably not a big interbank transaction guy. So he's going to be a little bit out of his comfort zone, which may help, because he's going to be just effectively sticking to a script, and rather than going from the hip as a CEO, letting everybody know that things are fine.
He may be talking to crickets there.
What's that?
Did I hear crickets?
I've got a million different alerts and shouting at me. But yeah, I think that if there's been a theme to how Powell has seemingly mishandled some of these press conferences, I think that he feels a little too comfortable with how he's expressing things, and maybe he should be a little less comfortable. a little less of a sense that he's just going to kind of shoot from the hip and straight talk us into a different place. So this may be a different feel to the press conference, especially if he starts off with this, because he's probably going to be going from what staffers have presented to him as the important points to make.
Yeah, and we'll probably get a little bit of a better idea of what's going on, to be honest, in the minutes, where you'll see a lot of this back. You'll see a lot of the back, because the minutes, the first 5 to 10 pages, it's usually a snoozer with them just going through the day-to-day operations and what they're seeing. This time around, the minutes, when they're released in 3 weeks from today, will be a lot bigger of a curiosity for the market participants, I think.
Yeah, I think so too. So the question though is, so now that we've kind of, I think, let's say we've dealt with this, there's a peculiar technical issue. It really is a peculiar technical issue. If it's related to something that's big picture, it's related to the deficit size and the fact that the Fed is no longer, constantly monetizing the situation, and also maybe that we've taken measures that have reduced foreign participation in auctions. But beyond that, if we take a look at where the cycle is, we've got the opportunity for a bigger divergence. I mean, we're a week removed from the ECB and how the United States economy is characterized versus how Mario Draghi characterized the EU economy. This, I think, could be a bigger feeling divergence than we've seen in quite a while. Do you agree with that?
Yeah, I would. Well, I mean, I would certainly expect for Powell to highlight the weakness in the international and perhaps throwing out that it could wash upon our shores. But yeah, I mean, if we're just going off the data and everything, then it's tough to not see a divergent story coming out from here.
Right. So, I mean, where do you guys want to take this? I think that we're probably pretty much in agreement about what we're likely to hear today, at least on some level and at least conceptually. I suppose we could talk about what would be surprising. I think that it would be surprising if we got anything other. I think it would be very surprising if we got anything other than basically what we've just laid out. But which direction do you think would be the
no cut would be arguably the biggest surprise, I think.
The biggest surprise or the most likely big surprise?
The most likely big surprise.
Yeah.
Anything else, I really just don't see how they could change it. I mean, perhaps the dot plot, as I just said, could come in a little bit more hawkish than some people are expecting, but that's kind of turned into the baseline now, like there's been so many people talking about those plots simply not playing out to that 3 or 4 more rate cuts going on into 2020 at the moment. Perhaps if Powell was to reintroduce the word patience, that would be a little bit of a surprise, I think. I don't know if it would be a major surprise, but certainly one that we'd be on the lookout for. But I think the biggest risk in terms of surprises would be a no basis point or no rate cuts today.
So we're still, I think we've been cast back into, we thought we went from, remember how there was this narrative over the summer where, is this a one-off or is this an easing cycle?
Yes.
So we kind of went back to it's definitely an easing cycle, and now I feel like we might have gone back to it's a one-off meeting to meeting kind of thing. Right?
Yeah, and I think that came right around the line of the mid-cycle correction that he offered on July 31, right? And I think he actually explicitly used the term insurance cut too, which I recall being surprised that he would add that in. So. Right. Yeah, so I think that they definitely reined in that this was going to be a trend and more of a, we'll take it from meeting to meeting just to address how the economy's going. And with that as a backdrop, I mean, the economic data has been just extremely strong.
Yeah, and at this point,
strong, but better than feared, I suppose.
Yeah,
I think you laid that out in the Citigroup Economic Surprise Index, right, Brett?
Yeah, right. We finally turned back positive on that thing in one of the longest previous stretches ever of being constantly surprising to the downside. We've started to surprise to the upside consistently again. And I could see the Fed funds futures looking out. It looks like at this point, the one cut that we do today, most likely, the base case right now is that lasts us for the rest of the year. So no cut in December.
And that's something that's really been reined in a lot the last 2 to 3 weeks, I would say, because I nearly fell over absolutely. When I saw it down at 48% for a rate cut yesterday.
Yeah. So that's and that's kind of as we've seen the backup in yields to the upside after that panic down, and we've seen equities break out to the upside, and a few other measures that kind of show a sense of reduced expectations of an immediate shift toward recessionary data, certainly, and I think that's coming through here, and it will probably come through on some level today, which is why I think there's such a striking difference in the tone between what we're going to hear from Powell today and what we heard from Draghi last week, where Draghi was constantly calling on we really need fiscal stimulus. We're doing everything we can. We're going back to QE. We're cutting deeper into negative territory. We're trying to avoid a fresh collapse here, and then you're going to hear Powell today basically saying, probably we'll take it meeting to meeting, probably no more cuts this year. The
you think you go as far as saying probably no more cuts?
I don't know if he'll say that, but he certainly isn't going to say anything to tip back over into the concept of an active easing cycle is currently underway and going forward.
Maybe something along the lines of we're following data, and current data suggests that the level that we
Sure.
just cut to is the neutral rate, something along
Yeah,
those
something
lines.
along those lines, and I think that that's what the market is expecting, and I think that that's such a remarkable divergence in tone between the U.S. and the EU at this point.
Okay, I guess the next key thing for us to discuss would be some of the expectations for how the markets might trade this. And I know I'd be curious your thoughts on gold, Brett. Like, I could definitely see the QE headlines, like Jim was talking about, setting off some algos. The idea of another 25 basis point rate cut and that causing a spike in gold, and then for that to roll back over and perhaps getting that crash that you're looking for. I don't know what your thoughts are on that, but I'd be curious to hear them.
Well, I mean, you have seen a speculative. At this point, I think we went from being, if you go back to April and earlier in gold, we'd seen very low participation on the long side, and over the breakout that we've seen since then, which we were able to capitalize on, we have seen a frenzy of speculative money come into gold, and it's still sitting there. And I think that the Powell basically making sure that people understand this is a technical issue in terms of the repo markets, and that there may be an interesting opportunity to short gold, basically along the premise that Jim was suggesting earlier, where there's a reference to something that gives people the feeling of quantitative easing, and that really there's a knee-jerk reaction in various markets and one that subsides and reverses. And I think that that could offer up an opportunity to short gold in reaction. If you get that sort of knee-jerk reaction with that kind of algorithmic response to keywords, and you see something like 1535 or 1540 on the December contract, and then you start to fade it back down, that could lead to that splash under 1500 and down to check where the trailing 50-day moving average is, which is just below the spike lows from early August and would take us down maybe to a test of about 1485. So there's maybe 50 points there that could be a reasonable pattern expectation if we got a kick up on a knee-jerk reaction in gold in response to some of the keywords, if there's anything that sounds like quantitative easing, and if it's later revealed to be something that's just more technically a solution to patch up the overnight markets. So that would be a possible trading scenario. Hey guys.
Sorry, I was on mute there. What about for the indices, Brett? I mean, I'm looking for a little bit of heavier action. I don't really think it's going to be so much off the Fed as much as off of really the FedEx earnings and perhaps the lack of chance for further easing from the Fed. I don't know if you're leaning in either direction. I do think it'll eventually turn into a buy the dip candidate, because the idea that we're not seeing any more easing because the economy's too strong, I think bodes well for stocks in the longer term. But I do feel that we're going to have a tough time finding a lot of buyers above 3,000, given what we just saw from FedEx, which was one of the first August end reports that we saw.
Sure, absolutely. I think it's probably a struggle. I'd like to see a shakeout where we kick back up and move back down. Maybe check the 50 in the S&P. We moved back under the low that we saw earlier this month on the one shakeout bar that we had, back down into the 2960 to 2950 area. I think that would be an interesting level to take a look for a move to retest all-time highs.
All right. And let's see, we talked gold. What about the dollar, Brett, in your euro trade?
So, I mean, the one problem for the euro short right now, we're still easily in the money on it, but if I were to play skeptic here, is the idea of a receding sense that we're heading into anything that looks like a cycle rollover on a larger level, is where we can start to see a squeeze in the euro, because it really is about saying, okay, we're dealing with some part of the cycle rolling over right now that leads to that procession towards some kind of crisis point where we realize that there's just big problems. No matter how much they want to get fiscal stimulus going, they can't seem to get it going, and they've lost the voodoo magic from the ECB. and you start to get stressors of people wanting to move outside of the EMU rules to stimulate, and you get the possibility of other threats of exiting and other issues like that. So the short in the euro is really predicated on there being some kind of process of being able to identify movement towards some kind of cycle rollover. And if we've had a respite from that, and if we're seeing a reacceleration of growth, we may see the short squeeze out, including myself. So I'm going to keep the position on, and I'm going to keep risk just where I have it. And we do have going for us the idea that we see that huge divergence in tone, and we see that huge divergence in policy, and there's not a major short position in the euro. So that could be enough to just send it back down and move back through those lows. But really the big move down, where I think parity is possible, is if we're in some part of the stretch of cycle rollover. So, I mean, we'll see. I'm keeping the position on, still in the money. My stop is back, and I'm willing to let it play out.
All right. Well, seems like we might be having some audio issues here, so hopefully, we'll put some of this into writing so people have that. We'll circle back around. Sorry for the technical difficulties. We're continuously trying to work on that to improve that. But Brett, you got anything to add before we end this segment? Obviously, we'll be back on right after the Fed this afternoon to discuss what was going on just ahead of Powell, and then probably circle back around after Powell. But you have anything you want to add before we break off?
No, not really. I mean, I think we pretty much covered all the ground. I think probably the idea of the gold short that we described earlier may be the most interesting thing to me if we see a knee-jerk reaction to language that really has to do with calming the repo rate, and it's misinterpreted for some kind of larger QE type of stimulus. I think that offers the possibility of a fade in gold off an initial spike. So that's one thing I'm going to be looking at closely.
Okay, I think we're both in agreement there, and I think the same could be said about the indices as well, too. We'll be obviously looking for any setups on that front, but definitely could open up some interesting aspects. And then, of course, Brett will want to circle back 24 hours after to really see how the market's digesting everything and see how this changes.
Absolutely.
All right, we will be back on, like I said, right after the Fed. Obviously, we'll be talking up into that too over the next 2.5 hours and providing any color or commentary on moves that we're seeing within the markets. But Brett and Jim, thanks as always for joining us here, and looking forward to talking to you guys in reaction to this Fed meeting.
Gotcha. Okay, thanks, Gab.
Talk to you soon.